Disclaimer: this video is for educational purposes only and is not financial advice. Always do your own research before investing.
Guys, in today's video, I want to talk about how an ideal portfolio should look like. As you can see on the screen, the priority should be split between 60-30-10 ratio and giving the highest priority to the anchors or conservative core stocks like XIC, VDY, XTIV, XEI, or X7 or similar stock like this category. The next one is tier 2, which is boosters. You should be looking at around 30% allocation to HYLD, QQCL, USCL, HHLE, or HDIV, or similar stock like that. And the last 10% should be given to speculators or I call it ultra yield moonshots, stocks like MST, TSLY, NVHE, PLDTE, or CNYE. Or the alternative, you can also go with HHIS, which is the cumulative funds of funds consist of all of these underlying single stock enhanced high yields ETFs. And now let's deep dive why I'm recommending this portfolio and what is the reason behind this math. Here you can see a quick comparison of three Canadian ETFs, namely VDY, TSLY, and HHIS. As you can see, VDY is a better performer over the 1 year total return basis compared to HHIS or TSLY. The point is, high yield is not guarantee for the total better return, and we should be careful while picking ETF for our portfolio. Why three tiers? Why 60-30-10 split? The structure is simple. Tier 1 is your anchor. 60% of the portfolio is spread across 5 low-fee, broad Canadian equity funds that do the actual wealth building. Tier 2 is your booster, 30%, spread across 5 moderate leverage covered call funds that cover some of the Tier 1 style growth into a bigger monthly paycheck. Tier 3 is your pure speculator slice, 10%, spread across 5 single stock covered call funds with real capital erosion risk kept small on purpose. The anchor tier is built to compound quietly in the background. The booster and the speculator tiers are built to hand you cash on schedule you can actually budget around. Two different jobs done by two different kinds of tools. That's the entire reason this is layered system and not just buy the highest yield you can find. Let's go tier by tier with actual numbers. Tier 1 is not exciting, and that's the point. These are index style replication based ETFs holding real profitable Canadian business, banks, energy, telecoms, railways, no leverage, no options overlays. You own the company's full stop. XIC, iShares Core S&P and TSX capped composite. The entire Canadian market is one ticker, 229 holdings, led by big five banks, Shopify and Enbridge. Management fee is only 0.06%. Over the last 12 months, it returned 31.9%, including its roughly 2% dividend. This is your floor. It's not trying to be exciting, it's trying to make sure you are never starting from zero. VDY, Vanguard's Canadian High Yield Dividend Stock. This is concentrated fund. Royal Bank alone is over 15% of the portfolio. Financial plus energy make up the bulk of it. Trailing yield sits between 4 to 5%. 1 year total return is 53%. The strongest tier 1 performer. And the single strongest argument in this video for why total return and yield are different questions. XTIV, iShares Core Canadian Quality Dividend. Screens specifically for balance sheet quality before it screens for yield. Yield around 3.2%. 1 year total return is around 48%. Financial lead with 49%, then energy with 26%, and utility around 10% in composition. XEI, iShares S&P and TSX composite high dividend. Slightly broader dividend payer universe than VDY. Yield around 3.7% with 1 year total return of 38%. XFN, iShares S&P 500 TSX capped financial. A pure sector bet. You are buying the Canadian banking and insurance companies. Management fee is only 0.61%. 1 year total return is 47%. The second strongest fund in tier 1, which makes sense. It is effectively a concentrated version of what's driving VDY strength too. This is the highest conviction, least diversified pick in tier 1. Before reviewing tier 2, we need to understand what a covered call actually does. A covered call ETF owns the underlying stocks or index, then sells or writes call option against it. The buyer of that options pay a premium upfront, which then fund collects and pays out to you as extra income. In exchange, if the stock rallies past the option strike price, the fund's upside on that portion is capped. Someone else gets to buy your shares at the agreed price instead of you keeping the full rally. So, a covered call fund trades away some blue sky upside for steadier, higher current income. That's reasonable trade on its own. Layer on cash leverage, borrowing extra money to buy more of the underlying, and you amplify the both option income and the exposure to the stock's price moves in both directions. Keep that in mind because it explains everything you are about to see. You will often hear that these leveraged covered call funds are borrowing at the risk free rates. As of this month, the Bank of Canada's actual overnight policy rate is 2.25%. What these funds actually pay to borrow is closer to the bank's prime lending rate, currently 4.45%, sometimes with a small spread on top. So, the real hurdle for a 25% leverage fund is roughly the underlying portfolios need to clear approximately 4.5 to 5% just to pay the interest on its own leverage before a single cent of that leverage helps you as an investor. Here you can see on the performance chart of tier 2 boosters between HYLD, QQCL, USCL, HHLE, and HTIV. The HTIV is the lowest yield stock, but with the best total return of 42%. HYLD, Hamilton's Enhanced US Covered Call. Hold a basket of Hamilton's own US sector covered call ETFs, broadly mirroring the S&P 500 sector mix, then layering on roughly 25% cash leverage. Hamilton market this as having 0% direct management fee. Technically true at the holding company level, but all in cost investor bear rolling up underlying fund expenses is 2.37%. Current yield is 12%. 1 year total return is 26%. QQCL, Global X Enhanced NASDAQ 100 covered call, roughly 125% leverage on the NASDAQ 100, yield around 13%, management fee is 0.85%, with 1 year total return is 28.5%. USCL, Global X Enhanced S&P 500 covered call, same 125% leverage structure applied to the S&P 500, yield around 12.3% with 1 year total return of 24.7%. HHLE, Harvest Healthcare Leader Enhanced Income yielding 12.2% with MER of 2.69%. This is highest in this tier. 1 year total return is 10.9% positive, but the smallest gain in tier 2 relative to its other ETFs in the list. Healthcare had a comparatively quiet year, and the leverage plus free feed drag at a real chunk of what would otherwise have been stronger number. HTIP. Hamilton's enhanced multi-sector covered call. This is stand out of tier 2, yielding 9.8%, the lowest headline number in this tier, paired with 1 year total return of 42%. The best of any tier 2 fund and close to tier 1's strongest name. HTIV holds a diversified basket of Canadian sector covered call ETFs, broadly tracking the S&P TSX-60 with modest leverage. So it's rode the same Canadian financial strength that powered VDY and XFN. Proof that within tier 2, the fund with the lowest headline yield can still be the strongest total return performer. These funds work when their underlying sector or index has a genuinely good year. Because the leverage multiplies a real gain, they stall, not collapse, but stall when the underlying is flat. Because the 2 to 4% combined drag of fees and borrowing costs consume most of the upside. Compare HD's 42% to HHLE's 10%, same basic structure, same modest leverage, same monthly covered call income, and apply to two very different underlying market in the same 12 months window. The leverage and the options overlay aren't good or bad in their own. They are amplifier. Diversifying across 2 or 3 tier 2 names rather than the concentrating your whole 30% in one sector bet is how you avoid your entire booster tier turning into an HHLE year instead of an HT1. Tier 3 Speculator. Tier 3 is single stock option overlay, roughly 25% leverage exposure to one company at a time. This is where headline yields get genuinely absurd and where the gap between yield and total return becomes the whole story. The first one is MSTE, formerly MicroStrategy, a leveraged income overlay wrapper around a single company that is itself a leveraged Bitcoin. Roughly 63% of yield, 1 year total return is negative, whopping 81%. A 63% yield sitting on top of 82% collapse in the value of your capital. The single clearest example on the TSX right now of a yield figure that has become almost meaningless. because the income is being paid out of a rapidly shrinking asset base, not sustainable cash flow. Second one is TSLY. Harvest Tesla Enhanced High Income Shares. Current indicated yield is 34.3%. That's the most recent monthly distribution of 15 cent annualized against today's $5.25 price. Some data providers show a higher trailing yield here because there is averaging distribution paid earlier in the year. When the monthly payout was larger, the 34% figure reflects what the fund is actually paying out right now. MER of 1.81%, 1 year total return essentially flat, negative 0.18%. This is the cleanest illustration of the whole thesis in this video. A, a yield in the mid 30s and your total position is dead flat over the year. You didn't get a 34% raise. You got roughly your own capital back to you, one on a monthly schedule dressed up as an yield. Then comes the PLTE Harvest Palantir Enhanced High Income Shares, yielding around 37%, with 1 year total negative return of 17.8%. Palantir has been volatile. The covered call overlay caps the upside when the stock does rally, and the leverage adds downside when it doesn't. The income has been partial refund of a shrinking pool of capital. The next one is CNYE Harvest Coinbase Enhanced High Income Shares, yielding around 50% with 1 year total return of negative 63.5%. The last one is NVHE Harvest Nvidia Enhanced High Income Share, and this is the one I want to be completely fair about. Yielding around 22 to 24% range, 1 year total return is positive 35%. NVHE is proof that tier 3 is not automatically a bad trade, it is an asymmetric one. When the underlying single stock genuinely rallies hard, as Nvidia has, a leveraged covered call wrapper can deliver both a very large distribution and real capital growth at the same time. The catch is that this only works because Nvidia specifically kept climbing. Swap Nvidia for MicroStrategy, Tesla, Palantir, or Coinbase over the same window, and the identical fund structure produce a loss. In three of those four cases, a severe one. You are not being paid a dividend. You are being paid a distribution that's part real option premium and especially in down years, part return of your own capital. These funds take one more downside exposure through leverage than they give back in upside. Because the covered call caps the gain while the leverage doesn't cap the losses, that's generally asymmetric risk. And this is exactly why tier is capped at 10% in this blueprint. And here's the one rule that ties this entire video together. Practice NAV discipline. If a fund's share price is falling while the market or its sector is flat or rising, the way MSTE, PLTE, or CNY did this year, the yield is not free money. It's a partial refund of your own principal arriving on a monthly schedule. Real sustainable income comes from a fund whose underlying assets are actually growing or at least holding their value, which is exactly why tier 1's boring 2 to 5% yielders sitting on the top 30 to 50% total return and HTIF's comparatively modest 9.8% yield sitting on top of 42% total return are doing more of the real work in this blueprint than any of the eye-catching 34 to 60% yielders in tier 3. The tagline is yield is the headline, total return is the truth. Guys, let me know in the comments, are you already running something close to 60-30-10 ratio portfolio split, or is your current portfolio more front-loaded into tier 3 than you realized until today? This is Dividend North. Build the engine, but protect the capital that power it. See you in the next video. Thank you.